Welcome to this explainer. Grab your coffee, because I've got mine, and today I'm putting on my friendly financial advisor hat. We are going to be doing a much-needed financial checkup. If you've been looking at your retirement accounts lately, you might literally be feeling a bit of whiplash. We are seeing incredibly conflicting market signals right now, and we really need to stress test your strategy against them. So, we're going to break down exactly what is happening out there, pulling data directly from our sources to help you navigate this totally unique moment in the market.
So let's talk about this wild cognitive dissonance we're all feeling right now. Over here, you've got Asian tech markets and the S&P 500 literally going straight up to absolute record highs. I mean, the charts are beautiful. But then, on the exact same day, in the exact same global economy, we've got roughly 800 ships completely blockaded and stranded in the Strait of Hormuz due to escalating military tensions. It's a tale of two completely different realities. How can both possibly be true at once?
Here is our roadmap for today. We're going to cover 1, 2 markets, 1 portfolio, 2, the AI shield versus supply shocks, 3, the US versus Europe divide, 4, 3 AI warning signs, and 5, we'll wrap up with your portfolio safety checklist. All right, kicking things off with section 1, 2 markets, 1 portfolio. To really understand why the broader stock market seems to be completely ignoring geopolitical reality, we have to look under the hood. Think of the stock market right now like a towering, gleaming skyscraper. It looks massive and impressive from a distance, right? But when you look closely, that booming skyscraper is actually built on an incredibly narrow foundation. According to our market sources, just 7 companies, the Magnificent 7, are making up about 16% of the index. They are driving an overwhelming amount of the overall gains. And that brings us to a crucial concept for anyone managing their own retirement savings. Market concentration risk. If you are a beginner investor buying a standard index fund, you might think you're perfectly diversified across 500 companies. But actually, right now, your retirement portfolio is heavily dependent on the performance of just a handful of massive tech and AI stocks. If that narrow foundation shakes, believe me, the whole skyscraper is going to feel the tremor. Moving right along to section 2, the AI shield versus supply shocks. We are essentially watching an unstoppable force collide head-on with an immovable object. On one side of the scale, you've got the unstoppable force of the AI trade. We are looking at explosive spending, over $700 billion in capital expenditure expected this year alone from tech hyperscalers building out data centers and infrastructure. It's a massive wave of capital pushing the market up. But on the other side, we have the immovable object of the oil trade, specifically the looming threat of prolonged Middle East supply blockades threatening to pull the global economy down.
And the absolute crucial tipping point to watch here is $120. While Brent crude has recently been hovering around the $107 mark, market analysts are warning that if this blockade conflict drags into the summer, we could see oil push right past $120 a barrel. And that wouldn't just be an inconvenience at the gas pump. It acts as a massive, unavoidable tax on the entire global economy, destroying demand from the bottom up.
But here is exactly why the market is currently shrugging off that oil threat. And this brilliantly illustrates the Wall Street mindset right now, quoting a market strategist from our sources. The AI trade is ultimately an energy trade, but essentially, they're the price setters, so they can just pass them on. The market basically assumes these massive tech giants act as an invisible shield. Even if energy inflation spikes, these companies are so completely dominant that they can just pass those elevated costs right down to the consumers without taking any hit to their margins whatsoever. Which leads us to section 3, the US versus Europe divide. This whole AI versus energy dynamic, it hits different parts of the world in totally different ways. For US equity investors, they feel pretty largely insulated right now. Why? Because the US is an energy exporter and its market is heavily weighted toward those invincible tech giants we just talked about. Meanwhile, European investors are facing a much, much harsher reality. They are highly dependent on imported energy, making them incredibly vulnerable to supply shocks. Plus, Europe generally lacks those massive tech giants to drive their markets upward.
And as if the energy crisis wasn't enough, Europe faces an added geopolitical risk, a 25% threat. Specifically, the very real threat of the U.S. administration imposing a 25% tariff on European vehicle and truck imports because of ongoing trade disputes. This isn't just theoretical political maneuvering either. It has immediate market consequences. Analysts estimate that this tariff threat alone could wipe out anywhere from 12 to 20% of operating earnings for European automakers. We are actually already seeing major European auto stocks tumbling simply on the threat of this happening. It is a literal perfect storm of energy dependency and trade vulnerability.
All right, on to section 4,
3 AI warning signs.
So, if the US is insulated by its shiny AI skyscraper, is that foundation actually starting to crack? We can break down some really complex trading signals into a simple 3-step realization. First, the smart money, hedge funds, are actually selling tech. Second, the underlying macroeconomic fundamentals are subtly eroding. And third, we're seeing the return of stagflationary impulses. That's where inflation stays high due to oil shocks, but economic growth completely stalls out. Let's zero in on that first point for a second because it's massive. While retail investors are still hyping up AI and buying into the momentum, the data shows a huge sell-off behind the scenes. Hedge funds have actually marked their second biggest move lower in tech positioning in the last 10 years. They have been massive net sellers recently, quietly taking their profits off the table while everyone else is still buying the hype. That is a glaring, red-flashing warning sign.
And finally, Section 5, your portfolio safety checklist.
So where does this leave you? Let's put that financial advisor hat firmly back on. Here is a highly practical 3-point checklist for retail investors looking to hedge against these looming geopolitical and energy shocks. First, evaluate an equal-weighted strategy. Second, check your exposure to liquid alternatives. And third, look to balance your heavy tech exposure with cyclical catch-ups in other markets. Let's break these down. First up, consider an equal-weighted S&P 500 strategy. Remember that concentration risk we discussed, where 7 companies make up 16% of the index? Well, an equal-weighted fund fixes that by giving you an equal slice of all 500 companies. As our market experts noted, this strategy offers you natural, healthy exposure to AI and tech growth, but perfectly balances it out. It prepares your portfolio for when the broader, non-tech market eventually broadens out and rallies. It completely removes that terrifying top-heavy vulnerability. Next, you need a safety buffer for when those $120 oil shock scenarios actually become a reality. Experts are heavily suggesting adding liquid alternatives to your portfolio. This means stepping outside of just standard stocks and bonds. We are talking about allocating portions of your portfolio to gold, broader commodities, or even specialized instruments like catastrophe bonds. These assets tend to hold their ground, or even spike, when traditional equity markets get thrown into chaos by geopolitical events.
So I want to leave you with a really provocative question to think about as you review your accounts this week. Take a hard look at your holdings and ask yourself, is your retirement currently betting on uninterrupted global peace, or is it betting entirely on the unstoppable, flawless execution of the AI boom? Because right now the market is assuming both will go perfectly, and the data is screaming that that's a very fragile foundation. Use the checklist we discussed, stress test your portfolio, and make sure you aren't caught off guard. Thanks so much for joining me for this explainer, and keep learning.